Hi everyone. In this video, we will have a discussion on CARO 2020, which is applicable from 1st April 2021. Let us have an overview of this. Well, MC has notified with its notification dated 25th Feb 2020, the CARO 2020, which will supersede the CARO 2016 in consultation with NAFRA, the National Financial Reporting Authority, and by the virtue of 143 subsection 11. Now, the CARO 2020 is applicable on financial statements of the companies whose financial year starts from 1st April 2021. So why CARO 2020? We all know that before CARO 2020, CARO 2016 was there. And the main principle behind the CARO reporting is that to improve the quality of the audit report and to bring transparency and more disclosure to the shareholders of the company. Well, CARO 2016 covers the section clauses. CARO 2020 covers 21 clauses, which obviously improves the transparency, and it has some very good disclosures and additional requirement for the auditor, which will surely help in combating the corporate scams, which knows no limit now. Well, the criteria of applicability of this CARO 2020 is the same that was applicable for CARO 2016. There is no change in such requirements. So what forward? We knew that the CARO 2016 was just confined to the standalone financial statements and not applicable to the consolidated financial statements. But CARO 2020 has been extended one step further to be included in the consolidated financial statement too, and the clause name is 21. We will have a discussion over that in upcoming slides, but just let us have a glimpse over the changes in the reporting requirement. As you can see that there are 28 new reporting requirements, 16 reporting requirements has been modified, 7 reporting requirements has been carried forward without any change, and one reporting requirement of 16 has been deleted. So on net basis, there is a change of 50 clauses. So this is the timeline of the CARO reporting from 19 or even earlier till financial year 2021. CARO 2016 was applicable, but with effect from 1st April 2021, and we can say that for the financial year ended 2022, CARO 2020 supersedes the CARO 2016. So let us start our discussion clause by clause, where we will cover the below points, the below four major bullets. The first one is the additional reporting requirement. We will not go in detail of all the 21 clauses, rather, we will have focus on just amendment part and the new reporting requirement as per this CARO 2020 reporting requirements. What are its impact on the auditor's report? What are the audit evidences that may be required or that is required by the auditor to perform so that they can report more correctly, and what are the guidance notes insights, what the guidance note says, what the guidance note provides some clarifications in regard to certain clauses. So let us start our discussion clause by clause analysis. So the first amendment relates to the property plant equipment. In subclause A, as you can see, only a minor change has been made, that is, fixed asset has been changed to property plant equipment, which is in line with the Indian accounting standard or the accounting standard. Second subclause, that is B, which is a new reporting requirement about the maintenance of the proper records regarding the intangible assets. Earlier it was not there, and the requirement the auditor has to take for that is the intangible asset register, or it may be happen that the intangible asset might be included in the PP register. Now in subclause C, there has been a clarification regarding The leasehold land or building which is not covered or not required to be reported in case of title deed of immovable property not held in the name of company, provided the same lease agreement are duly executed in the favor of the company. It is just a mere clarification. So the next clause, that is D, which is a new reporting requirement, which requires the auditor to report on the revaluation of the property, plant, equipment, including ROU asset or intangible asset, and specify the amount if it's equals to 10% or more. Now, as we know that the India 16 or AS10 provides the option to the companies either follow the cost model or the revaluation model. If the company follow the cost model, obviously this clause will not be required to be reported and hence outside the scope of the CARO report. But if the company follows the revaluation model, then the auditor has to check whether such revaluation has been conducted by a registered valuer, and for that the auditor has to check the revaluation report and see whether the report is signed by the which valuer, whether the valuer is registered with any institution or not. And then the auditor will also have to specify the amount of the change if the change is equivalent to 10% or even more than the 10% of the net carrying change. Well, guidance note provides a bit clarification with regard to the revaluation. So the clause simply says that revaluation, but whether the upward revaluation or downward revaluation is covered. So the both is covered, whether the upward or downward, doesn't matter. Both are covered, and the revaluation shall not include the fair valuation of the PPE upon adoption of India's first time Indias, that is as per India's 101. The revaluation shall not include the remeasurement of the property, plant, equipment, or ROU asset, that is the change in the value of asset just because of the change in the exchange rate, that is as per Index 21 foreign exchange rates. Or revaluation shall also not include the ROU asset due to the lease modification as per India's 116. Now next, the subclause E, which is also a new reporting clause, which requires the auditor to check whether the company has appropriately disclosed in the financial statement regarding the proceedings that has been initiated pending against the company for holding any Benami property under Benami Transaction Prohibition Act 1988. So for that, the auditor need to assess the legal expense account or the professional charges account. The auditor have to scrutinize the board minutes, the audit committee minutes, or risk management committee minutes of the board meeting. The auditor also needs to take the management representation for that. Well, in this case, the guidance note specifies that the reporting is not applicable where the notice is received by the company as a beneficial owner only. Rather, the reporting is applicable only when the company is Benamida. Now, next reporting requirement relates to the inventory. Under clause 2, subclause A, there has been insertion of reporting regarding the appropriateness of coverage and the procedure of physical verification conducted by the management, and the materiality has been defined, that is 10%. Earlier it was left to the judgment of the auditor in with discussion with TCWG. So it simply states that the auditor has to state whether the coverage and the procedure of verification by the management, whether the same is appropriate or not, and if there is any discrepancy in such physical verification, whether the same has been properly considered in books of account, provided the discrepancy is 10% or more of that each class of inventory. For that, the auditor has to check the management physical verification report. Auditor has to obtain the inventory physical verification policy and scrutinize whether there are any differences or discrepancies of 10% or more. Now, in next clause B of clause 2 of inventory, that is a very new clause which requires the auditor to report whether the company has been sanctioned working capital in excess of 5 crore rupees in aggregate from banks or FIs on the basis of current assets, then whether the quarterly return filed by the companies are in agreement with the books of account. If not, then give details. So this is basically a new reporting requirement on only applicable when the company enjoys working capital. So for that, the auditor have to check the sanction letter of all the working capital loan or with sanction limit above 5 crore and where the current asset has been offered as security. Then the auditor has to also check the quarterly returns filed by the company, and auditor will have to obtain the reconciliation of that return with the books of accounts. Well, guidance note provides the following the guidance note provides the following clarification with regard to this clause. That is, the auditor has to focus on the only on sanction limit, not on the utilization amount. That is, it may happen that the company has been sanctioned 10 crore working capital limit during the year, but the company has utilized only 4 crore during the year. So in that case, the same is also required to be reported since the sanction limit has crossed 5 crore. Second one is fresh sanction as well as limit renewed are both covered. It may also happen that the working capital was sanctioned in last year, but currently it has been renewed and extended to more than 5 crore. The same is also required to be reported. Third one is both fund and non-fund based are covered, whether from banks or financial institutions. And the fourth one is quite interesting. If the return is filed monthly, for example, it may happen that the working capital loan is of say 500 crores. So the bank requires the companies to file the quarterly returns. No quarterly, but rather monthly return. So in that case, the auditor will have to check the returns of the months that pertains to the quarter end, that is June, September, December, and March only, not for the 12 months. So next amendment relates to the clause 3, that is loan, investment, guarantee, or security provided. So the next amendment relates to the clause 3, that is loan, investment, or guarantee. So in subclause A or B, the major amendment is that earlier it was only required to be reported in case the loans, advances, or investment in guarantee or security provided to the parties which are covered under section 189. But now the CARO 2020 requires the auditor to report such cases whether made to any other parties. Means it is not just confined to the 189 register, that is MVP 4. No. Next, in clause E and F, these are the two new reporting requirements. The clause 3 subclause E requires the auditor to report in case there is loan renewed or extended, a press granted to settle the existing loan to all such parties, then the aggregate amount of such loan renewed, sanctioned, or settled has to be reported, and the percentage of the aggregate of total loans in the nature of loans shall be required to be reported. Now, subclause F requires the auditor to check whether the company has granted any loans or advances in the nature of loan, either repayable on demand or without specifying any terms or conditions, and specify the aggregate amount of such loan, and then specify the aggregate amount of such loan, therefore to the total loans and the percentage of the total loans. Now, in terms of subclause E, in terms of E, the clause requires the auditor to check if the loan falls on the balance sheet date and renewed post balance sheet date before the date of audit report. The same will also be considered for the purpose of reporting under this clause. The next amendment relates to the public deposits. It is very small amendment, I say. Earlier, only the public deposits were required to be reported, but now it has been extended to deemed public deposits. In subclause, in clause 7, statutory dues, the goods and service tax has been included, which was not there earlier. And in subclause B, all the statutory dues under subclause A has been covered, which was not there earlier. Now in clause 8, unrecorded income, this is a new reporting requirement, which requires the auditor to check whether the transactions which was not recorded in the books of account but have been surrendered or disclosed as income in the year in the tax assessment, whether the same has been recorded in the books of account that is audited. So for that, the auditor has to obtain the schedule and details of all the income tax assessments or proceedings completed during the year and completed post balance sheet date, but before the date of auditor's report. The auditor will also have to obtain the management representation in this regard, and the auditor has to obtain a copy of the statement made in the course of search and survey under section 133A of the Income Tax Act. Well, guidance note clarifies whether the company chooses not to file an appeal, it cannot be presumed that the company has surrendered or disclosed income. Now let's come to the clause 9, the borrowings and repayment. So in clause 9, which has been extended to include the interest amount also, and any lender is required to be reported. Earlier, it was just confined to the principal amount and for which the loan has been taken from the banks and FIs. But now it says that whether the company has defaulted in repayment of loan, that is the principal amount, or the borrowings, or in the payment of interest thereon to any lender, the same has to be reported. So there are major two amendments. First, interest amount is covered, and second, the coverage of reporting is expanded to include all types of vendors. Now, in subclause B, this is a new reporting requirement which requires the auditor to report whether the company has been declared willful defaulter by banks, by FIs, or by any other lender. Well, by any other lender, it means that only the government or government authority should declare the company as willful defaulter, then only it is required to be reported. Well, in that case, the auditor can take the credit report of or from any agency like Civil, Graphics, Equifax, Experian report of the company. Now, the guidance note also says that if the company has been declared willful defaulter post balance sheet date but before the date of audit report, the same should be considered true for the purpose of reporting. Now, next reporting relates to the borrowings and repayments of clause 9, that is D, E, and F, which are all new points which was not there. Let us have an overview of these two. So first one, D specifies that whether the short-term loan has been utilized for the purpose of long-term loan, the auditor has to check and report. The second one is whether the company has taken funds from entity to meet the obligation of subsidiary and associate or joint venture. The detail of such nature of transaction has to be reported along with the amount in each case. Or whether the company has raised loans on the pledge of securities held in its subsidiaries, associate or joint ventures, then the auditor has to give the details thereof and the company has defaulted if the company has defaulted and repayment of such loans. Now there has been a few amendments in clause 11 and clause 12 too. In clause 11, that is related to fraud, one line amendment is that any fraud by the company or on the company by anyone has to be reported by the auditor. Earlier, it was just confined to its employees or officers. And then in subclause B, whether any report under subsection 143, subsection 12 of the Companies Act has been filed by the auditors, that is ADD 4, the auditor has to report that. and whether the auditor has considered the whistleblower complaints received during the year. That is also required to be reported. Then in subclause 2 that is related to Nidhi company, the auditor has to report on the default of payment of interest on deposits or repayment thereof for any period, if so, the details thereof. Next amendment. So let's jump to the next reporting requirement, which is in clause 14, that is internal audit. So auditor now has also to report on the internal audit system, which is whether incommensurate with the size and nature of the business. This is a new reporting requirement which is not there, but which was there in CARO 2013. Also, whether the statutory auditor has considered the reports of internal auditor or not, the same fact has to be stated. For this, obviously, the auditor requires the internal audit report of the company, the details of the internal auditor, the qualification, the experience, the number of personnel engaged, the approval for the appointment of internal auditor, the policy of the appointment of internal auditor, and what are its rotation policy. Next amendment relates to the clause 16, that is registration under 45(1)(a) of the RBI Act. As we know that in CARO 2016 there was only one clause relating to this RBI Act, but now there is three additional clauses, which basically requires additional reporting. That is the clause B, which requires the auditor to explain whether the company has conducted any non-banking financial or housing finance activities without holding a certificate of registration. C requires the auditor to explain or report whether the company is a core investment company and whether it continues to fulfill the criteria of CIC, the core investment company, and in case it is exempted or unregistered, whether it continues to fulfill such criteria. The clause D requires the auditor to report on the group whether the group has more than one CIC. If yes, then indicate the number of CICs of which are part of the group. So these reporting requirements may not be applicable in most of the cases, but it is there in CARO 2020. Now clause 17, 18 and 19. These are the new reporting requirements for the auditor. The clause 17 requires the auditor to report on the cash losses that the company has incurred in the financial year and in the immediately preceding financial year. If so, then the auditor will also have to state the amount of losses. Second, clause 18 requires the auditor to report whether there has been any resignation of the statutory auditor during the year. If so, whether the auditor has taken into consideration the issues, the objections, or the concerns raised by the auditing auditor. This case is very much specific and depending upon the circumstances. Clause 19 requires the auditor to report on the financial stability of the company for only next financial year, whether the company will be able to meet its financial liabilities for next 12 months on the basis of the ratios, agings, expected dates of realization of financial assets. So basically this reporting may be also called as a prospecting reporting. For this, the auditor has to obtain the details of existing liabilities as long as with the due date of payment. The auditor has to check the subsequent payment status as on the date of auditor's report. The auditor has to obtain all the director's report, management discussion analysis, minutes of the meetings. The auditor should obtain the calculation of financial ratios as on the date of balance sheet and also on the date of the auditor report for analysis further. Next, clause 20 relates to the amendment of CSR. Earlier, there was no reporting requirement with regard to the corporate social responsibility, but now it has been added, which in somehow is also in line with revised schedule 3. So, clause 20A requires the auditor to report on the fact whether the company has transferred the unspent amount to a fund specified under Schedule 7 of the Companies Act within a period of 6 months of the expiry of the financial year. And Clause 20B requires the auditor to report whether any amount remaining unspent in respect of the ongoing project has been transferred to the special account with respect to 135(6) of the Companies Act. So basically, it is a new reporting requirement, and the auditor has to report on whether the unspent amount of CSR has been transferred to the designated bank account or a fund specified under Schedule 7. For that, the auditor first needs the computation of the CSR expenditure to determine the actual amount required to be expended. Then the auditor will also have to obtain the board resolution (BR) for the amount approved by the board of directors for the CSR expenditure. Then the CSR committee minutes and the CSR policy has to be taken. The auditor will also have to see the actual amount spent with appropriate documentation and take the management representation regarding this. And this is the last clause, clause 21, which is applicable on consolidated financial statement. So this requires the auditor to report whether any qualifications or adverse remarks have been made by the respective auditors, that is a component auditor, in the CARO 2020 report, then the auditor of the parent company, that is the group auditor, will indicate the details of such companies and indicate the paragraph number of the CARO report containing the qualifications and adverse remarks. This will be applicable in case of group audit only, where the company has subsidiary, associate, or joint ventures. For that, the auditor has to obtain the list of subsidiaries and associate and JVs, and the auditor has to take the obtained CARO report from all the entities from the management. Well, guidance note specifies some clarifications. The first one is not to consider the qualification adverse opinion on the auditor's report for the purpose of reporting under this clause. It means that SR 705, SR 706 need not be considered, or it will be irrelevant for the reporting under this clause. It simply says that whether any negative remarks are there based on the CARO report are only taken into consideration. That's it, guys. Thank you for listening to this CARO 2020. I hope you like it. Please share, subscribe the video if you like it.